Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with Arise Mortgage. Grab a bubble tea and enjoy the episode.
Welcome back to the Asian Connection Mortgage Podcast. My name is John Lee, mortgage broker and financial advisor located in Vancouver, Canada. Today, we're going to talk about an investment that often flies under the radar. It's not a GIC, it's not a standard mutual fund, it's called a segregated fund, or another way to call it a seg fund for short. Now, if you've heard of these, you might think they are just expensive mutual funds. And it is true, the fees are higher, but there is a very specific reason for that cost. It has everything to do with protecting your family and estate planning. Here's the simplest way to think about it. So a mutual fund is an investment basket. You own stocks and bonds in a portfolio. A segregated fund is that same basket, but it is wrapped inside an insurance contract. Because it is an investment contract, it does things that a bank investment simply cannot do. It protects your privacy, it bypasses the courts, and most importantly, it protects your principal for your beneficiaries. So today, I'm going to break down exactly how that works, why business owners use them to hide money from creditors, and why this might be the best way to pass wealth to the next generation. So let's start off with the first part, the death benefit guarantee. So when you buy a standard mutual fund at, say, a bank, you're taking on 100% of the risk. So you invest $100,000 and the market crashes right before you pass away, and your account is now only worth, say, $60,000, well, your beneficiaries get $60,000, and that's $40,000 of your hard-earned wealth gone. For segregated funds, segregated funds fix this problem with something called Segregated funds fix this problem with something called the death benefit guarantee. Here's how it works. You invest the same $100,000. The insurance company has options where it guarantees the initial investment. Upon your death, your beneficiary will receive either the market value or your principal investment, whichever is higher. Let me give you two scenarios. So first part, the market does great. Your 100,000 grows to 150,000, you pass away. Your beneficiary gets the full 150,000. That's great. And the second scenario, the market crashes. Your 100,000 drops to 70,000, and then you pass away. If this were a mutual fund, your family would get 70,000. But because it's a seg fund with a 100% death guarantee, the insurance company tops it up. Your beneficiary gets a check for the full $100,000. They are protected from the market downturns that happen at the worst possible time. It essentially puts a floor under your legacy. You know that no matter what happens in the economy, the money you put in is the minimum your family walks away with. So bypassing. Now, the guarantee is nice, but for a lot of my clients, the real value is in the logistics of death. I know it's a morbid topic, and for me, being Asian, I don't enjoy talking about this either, but we have to talk about probate. When you die with assets in a bank account or a standard investment account, the money usually has to go through your will, and wills have to go through probate. Probate is a legal process where the court validates your will. It costs money. The government takes a percentage. In BC, it's 1.4%. And it takes time. Your beneficiaries might be locked out of that money for months or even a year while the lawyers fight it out. It is public. Once a will is probated, it's a public record, anyone can see it. Segregated funds bypass this entirely. Because a seg fund is an insurance policy, you name a beneficiary directly on the contract. When you pass away, the money doesn't go to your estate. It doesn't go to the courts. It goes directly to the person you named. Usually, I would say around 2 weeks. Why does this matter? Well, imagine you have a blended family, or maybe you have a business partner you want to buy out. Or maybe you just want your kids to have immediate cash to pay for your funeral or estate taxes without waiting for the bank to unlock your accounts. Seg funds provide that immediate liquidity. And because it bypasses probate, it's private. No one else would know about it. This is why sometimes I like to rename seg funds as wealth transfer funds. This next point is huge for the business owners listening. If you're self-employed or you run a corporation, you know that liability is a constant stress. If you get sued or if the business goes under, creditors can often come after your personal assets. Standard RSPs at a bank might be protected in bankruptcy, but it's always not guaranteed. Standard RSPs at a bank might be protected in bankruptcy, but it's not always guaranteed, and it gets messy. Segregated funds offer much stronger creditors' protection. If you name a family class beneficiary, so a spouse, child, a parent, or grandchild, your segregated fund is generally protected from creditors. If you get sued, that money is protected. The creditors can't touch it. Now, a quick disclaimer, you can't just move money into a seg fund like on a certain day because you know you're going to get sued the next day. So that's fraud. But as a long-term wealth planning tool, it is an incredible layer of safety for entrepreneurs who want to make sure their retirement nest egg is safe from their business risks. So this all sounds great. Principal protection on death, no probate, creditors protection. Now what's the catch? The catch is the MER, which stands for the management expense ratio. Basically, the fees. You don't get insurance for free. A standard mutual fund might charge you, say, 2% a year in fees. A segregated fund might charge you 2.5% to 3%. That extra 0.5 to 1% is the premium you pay for the death benefit guarantee and the creditor protection. So how does this compare to GICs? Well, GICs are safe, but they have low growth and your money is locked in. Seg funds are liquid. You can cash out, though you lose the guarantee on the withdrawn amount, and have higher growth potential because they are invested in the market. And compared to mutual funds are cheaper. If you are 30 years old and have no dependents, perhaps you might want to stick with mutual funds. You don't need to pay for estate protection yet. Who is a seg fund for? Who is a seg fund for? It is for the person who says, I want to grow my money in the market, but I want to make sure that if I die tomorrow, my wife, husband, kids get at least what I put in without the government taking a cut or the lawyers holding it up for a year. So to wrap this up, seg funds are a strategic tool. They aren't for everyone though, okay? So if you are young and just building wealth, the fees might drag down your returns. But if you are approaching retirement or if you own a business, the death benefit guarantee and a probate bypass are features that simply don't exist in other investments. This is all about control. It's about ensuring that your money goes exactly where you want it to go, exactly when you want it to get there, regardless of what the stock market is doing the day you pass away. So that's it for now. If you have any questions about estate planning or how this fits into your financial strategy, send me a message. I'm happy to discuss with you. Thank you for listening, and I'll see you in the next episode.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the Asian Connection Mortgage Podcast.